Ladies and gentlemen, good day and welcome to the Sandhar Technologies Limited Q1 FY26 earnings conference call hosted by Emkay Global Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Chirag Jain from Emkay Global Financial Services Limited. Thank you, and over to you, sir.
Thank you, Anushka. Good morning, everyone. On behalf of Emkay Global Financial Services, I would like to welcome you all to the 1Q FY26 earnings conference call of Sandhar Technologies Limited. Today we have with us from the management team, Mr. Jayant Davar, Chairman, Managing Director and CEO, Mr. Neil J. Davar, Director, Mr. Gurvinder Jit Singh, Whole-Time Director and Head of Corporate Strategy, and Mr. Yashpal Jain, Chief Financial Officer and Company Secretary. We'll begin the call with opening comments from the management team, followed by the Q&A session. Over to you, Mr. Davar.
Good morning, everyone. Thank you, Anushka, and thank you, Chirag, for putting this together. Let me begin by, first of all, saying hello once again to this Trump-affected world. but I think where India is concerned, I do believe that we will probably gain in the end than lose. In today's call, I'm sure that all of you have received the presentation, the investor presentation. You have a copy of it. But let me focus on just 3 or 4 things to begin with. Can everybody hear? I hear some kind of a hiss. Can everybody hear me? Chirag, Anushka?
Yeah, it's audible, sir.
Yes, sir. Your audio.
All right. Okay. Let me begin by a few of the comments or a few points to make. First of all, on Sandhar's growth, we are happy to share again that we have achieved a growth of 21% growth over the quarter one of financial 2025. In fact, in the India business, that the growth is 22% at a consolidated level. And we expect to continue the growth momentum over the last year's numbers, depending, of course, on the geopolitical situation, uncertainty with tariffs, not that we get affected by the tariffs, but in the overall sentiment, growth in the auto and OHV sector, and of course, other related events that could come. Our consolidated EBITDA stood at 9.18 in the current quarter versus 9.85 in quarter one of 2025. These are exceptional reasons. There is a reason of the foreign currency translation loss, which is notional, which is 4.5 crores. There is the commodity price impact in this quarter, which will be covered up, of course, in the next one, but that's close to 3 crores. We have a one-time old lag of power change cost in Mexico. That's one time. That's again cost us about 2 crores or so. There were 2 of our customers who, because of their supply issues, not demand, supply issues, lost us a business of about almost 20 crores. And then there is the changeover that is happening in the construction sector from BS4 to BS5. And that also put a stint on the sales for this particular quarter. It is a part of the presentation, but I thought it fit to give my comment on it, and I'll be open for comments there as well. In terms of joint ventures, the company has reviewed its strategy to continue in the JV business format. We are consolidating our business activities and focusing on core business. But I'm very happy to announce that besides the 2, one is Jinyang Sandhar Mechatronics and Kwangsung Sandhar Technologies, where we sold off our stakes in these companies. The balance JVs that we have are all profitable. Currently, the company has an investment of 62.72 crores in the 5 JVs. and I'm happy to announce all of them are positive, both EBITDA and PAT. In terms of our overseas subsidiaries, you're aware that the European and other global markets have faced severe degrowth, marked by unstable geopolitical conditions and now being exacerbated by the U.S. tariff uncertainty. There's been a slowdown in Europe. There is decrease in consumption there, and most of the countries there are facing degrowth. Costs there are increasing. These have also affected us, our overseas operations, and we've registered a loss of 1.06 million euros. This is including the foreign exchange translation loss of 0.46 million. So half of it is on account of foreign exchange translation loss in quarter one, compared to a profit of 0.04 million in quarter one of 2025. Well, you'd be happy to know the company has taken many steps now to reduce costs, increase operational efficiency, and expand the customer and product base. We are very, very hopeful that 25-26 would be crucial to turn around our overseas operations and bring them into profitability. The last aspect I want to speak about is our EV foray. The company has started commercial production of battery chargers, motor controller, and DC-DC converters, and is getting very positive response from the market. The customer base is gradually increasing with more customers, and we generated a revenue of a little less than 2 crores in the first quarter to begin with. With that, I open the house for questions. We have with us today Neil and GJ, who are joining me as directors, and we have Mr. Yashpal Jain, who is the CFO, who will take on any questions regarding to any numbers or so on and so forth. With that, thank you very much once again, and we are open for questions now. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Aditya Kondwar from Complete Circle. Please proceed.
Hi, good morning. Thank you for that. So first question was on the 500 crore QIP. Any color on how the proceeds will be used? And second, my question on debt. I know, of course, last phone call also Mr. Yashpal said the debt may peak a bit, but then still just wanted an update on the same. Thank you.
Yeah, Yashpalji?
Yes, sir. So, morning, Aditya. Replying to your first question regarding the QIP. So we have put up a proposal to raise up to rupees 500 crores, and largely we are focusing on some more acquisitions which may come up during the year. As you know, the validity of this approval from the shareholders is for a year. So we thought to put it before the board to subsequently take it over to the shareholders. And the large part will be used, or I would say the major portion will be used for the further future acquisitions, as well as some acquisitions, as you remember, in the month of March we have done. And we are expanding those lines also to increase the capacities. So this is regarding the QIP. Coming to the debt portion, we had a gross debt of 862 crores as of June and a net debt of 825 crores. And I think as I spoken in the earlier calls also last year, while doing an update on the Q4 FY 24-25, the debt pressure might continue during this year because of the past acquisitions that we have done in the month of March and some of the new projects that are coming up. But yes, we tend to keep the debt levels of debt within the present limits. Actually, we don't want that it crosses 900 crores at any point of time. So we'll try to rationalize it between 850 to 900 crores at the maximum side.
Thank you, sir. All the best.
Thank you.
Thank you. Before we proceed with the next question, a reminder to the participants, in order to ask a question, you may press star and 1 on your touchtone telephone. We take the next question from the line of Saurabh Jain from Sunidhi. Please proceed.
Hello. Yeah, thanks for the opportunity, sir. I have few questions. To begin with, what was the revenue and EBITDA contribution from the acquired business of Sundaram during the quarter?
So the revenue was some above 100 crores. You can say it's around 103 crores for the quarter one. And as far as EBITDA is concerned, it was a EBITDA business, but at the PBT level, we have sustained losses. As I mentioned in the earlier calls, the cost has been higher. The EBITDA has been at a level of 4 crore rupees. It was around 4%. Because the operational costs, we started operations from 1st April 2025, and as I mentioned in earlier calls also, this year would be a little bit tough year because we are operating from a shared premises from the seller's premises itself, which is a common complex for other companies also. So might be this year, it would be at a break-even level by we close the year end. But yes, from next year onwards, it will be back to the normal margins that we expect from a die casting business.
So break even at EBITDA level or?
No, EBITDA level we'll try to sustain around 6.5% by the year end. EBT level can be a flat. EBT can be a flat level. Yeah.
Okay.
Because this was the first quarter. April we started the operation, so the quarter was a little bit challenging also in terms of organizing the activities, organizing the operations, so the costs were higher.
Okay. And sir, my second question is, what was the contribution from smart locks in this quarter, which we were expecting the revenue recognition to begin in this quarter? So how do you see that moving in the coming quarters?
So like for the smart lock, it's just the beginning as we saw some pilot projects, pilot lots have been submitted to the customers. So you need to wait for year end, at least this year end, when the volume shoots up, because it's directly dependent on the sales of the OEs. From our side, we are ready to supply any quantity that they require. But as of now, for this first quarter, the volumes are quite, I would say, a test sample types. A very minuscule type of volumes are there for smart locks. And I think by the year end, the penetration should see, depending on how the country performs, how the consumer demand picks up and the preference of the consumers with respect to the models which are carrying the smart locks.
Sir, coming to cabins,
just to add to that, let me put it into perspective. We are looking at the first year expected volumes of smart locks are about between 60 to 70,000 numbers.
That's helpful, sir.
Yeah, 60 to 70,000 numbers for customer one, and about half of that for customer two.
Okay. And that's for this fiscal FY26.
That's right. That's right. And basically the offtake, while like Mr. Yashpalji said, the pilot lots have all been validated and are fitted onto vehicles. The ascents will start from quarter two, but the overall impact of this would largely come in the second part of the year, and of course it will go on to a regular platform from year two, which is the next financial year.
Great. Sir, coming to cabins and fabrications, which recorded a moderate degrowth. So was that due to the new norms with respect to air-conditioned cabins? Do you see this segment see a rebound?
No, this has nothing to do with air-conditioned cabins. This has to do with the engine norms of BS4 to BS5.
Okay. Okay.
So BS4 to BS5, engine change, price difference. So the customers had built and supplied in the market with the BS4 vehicles. BS5 changeover is happening now. So when that happens, the entire ecosystem kind of changes. And therefore, we expect that I would expect from the next month onwards, probably, sales would get back into normal levels.
Okay, so the pent-up demand of last 2 quarters should eventually make up for the rest of the year, right?
That's difficult for me to say. That's difficult for me to say what the new demand is going to be, because the newer vehicles will also cost a little more. So the market needs time to get used to new prices. Therefore, the construction equipment manufacturers had pushed larger numbers to get rid of their Euro 4 or BS4 vehicles. the new demand is being built. But in the meantime, there is a lag that happened in quarter one and will probably continue till next month onwards. So you will get let me say, a regular demand from the half of the second quarter.
Great. Sir, my last question is on if you see the category-wise split, so four-wheelers, OHVs and CVs all have seen a lower contribution, both on QOQ and YOY basis. So of course, that may be due to good growth in two-wheelers, but at the same time, if we see these revenues from four-wheeler, OHVs and CVs in absolute terms also, there has been hardly any growth. So how do you see this split shaping up for the full year and FY27, if you can comment on?
I had started today's call with telling you that two of our customers had suffered their production on account of supply issues. For example, I can even name to some extent, let's say the business of Hero. They had supply issues, so they literally manufactured a little over half of what they normally do in the months of April and May. They, of course, are ramping up now and they don't want to change the business plan for the year. So I'm sure they will recover. But in the meantime, that suffering that happened in the first quarter affected all of us.
Okay. And one small question, if I can squeeze in. Sir, we were expecting like 0.5% kind of EBITDA margin expansion in this fiscal. So in the first quarter, we have, of course, a few one-offs, which you explained. So are we on track to have that 0.5% of EBITDA margin expansion for the
at this point of time, we see no reason to change our projection. Yashpal, do you want to add something to it?
Yes, sir. Adding to that, we are very much on the targets of improving the margins by 0.5%. First quarter has been exceptional with few of the exceptional items that we have mentioned in the investor presentation also. So starting quarter 2 to quarter 4, the recovery would be coming up, especially in the acquired businesses also, as well as the overseas businesses also.
Great. Thanks. That's all from my side, sir. Wish you all the best.
Thank you.
Thank you. Before we proceed with the next question, I would like to again remind participants, in order to ask a question, please press star and 1 on your touchtone telephone. We take the next question from the line of Saket Kapoor from Kapoor & Co. Please proceed.
Namaskar, sir. Am I audible, sir?
Namaskar.
Yes.
Yes. Sir, if we summarize the first quarter operational performance and we take the one-off out from the sales from the profitability part, this has been a tough quarter. So in terms of profitability also. So if you could just give some sense, although there is an increase in revenue, but when we removed the other income component, the profitability has taken a hit. Is that understanding correct, sir?
No.
Yes,
it is not. So let me just answer this in my form, and then of course Yashpalji will explain this better. See, you have to understand that 10% of the revenue, which came from the new acquisition, had a negative content to it in terms of bottom line, both at EBITDA and PAT levels. Right? We suffered losses, and the EBITDA margin, like he said, was only 4 crores, which is about 3%, compared to the other numbers, which pulled the entire thing down. If you have the analysis of reasons and normalized margins, I think that's a part of the investment presentation that we have given. If we look from that perspective, then our EBT margin, if you were to take those one-offs, comes to a level of 5.64% at EBT level. So it is higher. Normalized EBIT on our understanding here was in the level of 78 crores compared to what we have. So there is a huge difference in this entire ballgame. Yes, Raj, you can explain more on this.
Yeah, sure, sir. So basically, if we compare the operations wise, after eliminating these one time, or I would say the exceptional items, there is not a fall in the profits because we review on a unit to unit basis. Exceptionally, there are only 4 or 5 units which are in the maturity level, especially the newly acquired business Sundram Clayton, and 3 other units which we have commissioned in the last year, and they are yet to achieve the volume. So taking these together plus the overseas operations, these have contributed negatively. Rest, all the other businesses are performing well. And in cabins and fabrication, yes, 50% of the margins we got a hit this year compared to the corresponding quarter one because of the lower volumes. As in the, I would say previous, question answer, as sir has told, that the migration from BS4 to BS5 has taken a toll. The volumes are lower from the customer side. Rest, all other operations, all other units are working perfectly well and as per our projected plan.
Sir, in the P&L, on a consolidated basis, we find this other expenses line item to be not in proportionate to what it has been earlier. So what does this other expense line item of 176 crore one-off include, sir, for this quarter, sir?
So like these also includes the foreign translation losses also, one thing. Secondly, as we told... Hello?
Yeah, please.
Hello?
Yes, sir. Yes.
Yeah.
Please continue.
And secondly, as we told, like we acquired Sundram Clayton's business, the first quarter has been challenged, so there has been some initial costs also, which we have charged to the P&L account. And 3 of our plants, which were commissioned last year, their expenses of testing, development, all those stuff are coming up, which cannot be classified because these other expenses are very residual category. It's comprised of nearly more than 50 to 60 GL accounts. So that's the reason these are the initial costs. The initial, you can say, development costs, initial setup costs, which have been charged off, and also it includes the foreign exchange fluctuation also within it. That is the reason, the translation fluctuation.
Sir, as you answered to earlier participant, that the translation loss is only to the tune of 2.5 crore. Was this the number which you mentioned earlier?
Translation is 4.5 crores. If you see our analysis in the normalized also, the translation is 4.5 crores for the overseas business. And you need to understand how it happens. Like in Romania, we operate in RON. Mexico, we operate in USD. And Barcelona, we operate in Euro. So Barcelona is a holding company for overseas operations. So first consolidation is done versus RON versus Euro and USD versus Euro. Then post that the reporting currency of the parent company is INR. Then the entire Euro is again reconverted to INR. So if you see the currency fluctuation between March and June, Euro is appreciated by 9%, 9.5% compared to INR, and the same is the case with USD versus Euro. So 4.5 crores we have taken in terms of Indian rupees, which has been accounted for. But when you take the translation from Romania to Barcelona and USD to Euro for the Mexican operation, that is a separate one. And when we consolidate, the entire expenses comes to a final end. So that's how. But there has not been any abnormal cost in the other expenses. Being a residual category, that is the reason it's going up.
Okay. So just to conclude on this point, so what should we expect on if we remove the one-off item for this quarter, that should be the run rate, I think so. If we compare it on a Q-on-Q basis, it is around 28-29 crore. So barring this currency fluctuation, which we do not know how the currency will behave, the balance 20-24 crore is what I assume is the one-off item, and that should be in a non-recurring manner. That should hold ground for the car.
So, Mr. Kapoor, I would request if you just go through this analysis of reasons. So, if we go through it, you will see total exception one time is 16 crores, right? Then in the new projects which are yet to achieve is 10.5 crores, 10.65 crores. That makes an impact of 27 crores. So, as our chairman also explained to the earlier participant that foreign currency translation loss, the 4.5 crores that we have shown, that is from the conversion from overseas to India. It all depends on currency size. If 100 rupees euro goes down to 90, this will be a reverse situation in the next quarter. Bearing the commodity price impact and the one-time power cost in Mexico, so the commodity price cost is depend because what happens is the customer reimburses us on basis of average price of the earlier quarter. And during the quarter, the buying price might be higher than the average price because the buying price of the current quarter. So it's a lag of one quarter which continues. But in case the commodity prices comes down, it will be a negative, I would say a positive impact in the coming quarter. Power cost is a one-time, non-recurring. 10.65 crores, it includes the Sundaram projects and other new projects, which is an exception, I would say, because second quarter we are expecting the volume should come up, and quarter one is always traditionally a lower volume quarter in terms of the auto industry. So majority of them are the exceptional one. Bearing them, if we eliminate 27 crores, we are back to the normalized EBITDA margins, and I think they should continuously improve also.
One small point.
Your question as to what it would have been, I think it's written in the chart. A normalized profit would have, at EBT level, would have been 61.43 crores.
Yeah.
Compared to what we have.
Yes, sir.
Compared to the number that you have.
Okay. Sir, and on the aluminum casting business, the consolidation part, if you could explain the rationale and the benefits that flows into. And I have one suggestion, sir. What we find as investors and analysts is that our presentations are uploaded at around midnight, at around 11:40, 11:45, and then the call is held very early in the morning at 10 a.m. So if these two can be adjusted, sir, that will provide us more opportunity and no repetitive questions which are present in the presentation.
All right.
Will not occur, sir, going ahead.
No, you have a good suggestion. What we will do is next time onwards, we'll probably give 24 hours before we have this meeting.
Yes, sir.
Because, the meeting was held yesterday. By the time we send our documents to SEBI and then prepare this, it obviously takes time. But next time onwards, we will make sure that we give a one-day gap before we have this conversation. What was your question, sir?
On the aluminum casting business consolidation, if you could just explain the rationale and what the benefit we will accrue going.
Yes. So what we are doing, sir, in the entire case scenario, we are consolidating businesses. So aluminum, which is now becoming a big entity, sheet metal, which is becoming a big entity, our automotive proprietary business, which is becoming a big category, and the fourth portion is the construction equipment. These are four being rationalized into large businesses. As such, these grew out of supplementary growth areas. So when we made locks, we started making zinc, then we started making aluminum parts and so on and so forth. But as we grew, we felt that there was an outside demand, and to meet that demand, when we started to grow these businesses, each one of them is now at considerable levels and are poised to grow much faster than some of the other businesses. So aluminum business, as you would see, I don't know what guidance we've given so far, but our internal business plan is literally to double from where we were last year. Similarly, sheet metal business, with the addition of 3 supplementary plants that have been put, is also growing at a level which is very, very aggressive. So we are developing these 4 verticals to grow much faster, and each vertical is being given the autonomy to become like an independent company. That, sir, is the case scenario where we will be able to use volume, scale, and growth and core competence of each business in a much better fashion than when we do it together as hybrids. Yashpal, you want to add something?
Yes, sure, sir. So, Mr. Kapoor, as you remember, 3 years back, we were operating predominantly into locks and mirrors, our parent business, the proprietary business. And gradually then we started leveraging to the market in terms of the new products, die casting, sheet metal, and we did a capex investments also in these projects. Now the purpose of hiving off these businesses to the separate entities to create large size companies to take on the competitors and the market effectively. Because earlier we were working in the hybrid company, the parent company, Sandhar Technologies, we used to contain 4 different verticals. So now we are focusing on a specialized companies with the dedicated teams, looking and concerning and focusing on their specific areas. So while Sandhar has cast will be dedicated to die casting business for aluminum and zinc, and they can effectively take on and capture the market. The same is the aim behind hiving of the sheet metal business to Sandhar Engineering, so that they can effectively create a large fabrication company more focused on that. And while the parent company will continue to develop and market the technologically driven products. So this is how the strategy is. And we want to create value for our all shareholders in terms of creating these 3 to 4 entities who are very sizable in size, and they can take on the market share very effectively and can create I would say, a long-standing effect in the market in terms of the products that we are operating on.
Okay. Sir, if I may just squeeze in one more on the CapEx and the new capacity addition for the year in the different vertical. What is the CapEx that we have outlined for the current year? How much have we spent for the first quarter? And the new capacity that will get commercialized during the year and its contribution to the total top line.
So like in the first quarter, we have spent 101 crores, which includes the balance consideration of 50 crores that we have paid to Sundaram Clayton. As you remember, we bought it for 163 crores, 113 we discharged before March, and 50 we have discharged on 13th of April. Right. Another 50 we have added to our existing, which includes some portion to die casting also and some portion to the sheet metal business also. This year, in terms of our more expansion plans, we are tending to spend something around 200 crores more. This includes, if you assume it would be 300 and minus the 50 crores was upfront that we paid to Sundaram Clayton. So effectively 250 crores of growth and as well as maintenance capex would be there.
Okay. And the new capacity which will get commissioned or will contribute to the top line for this year, what are the new?
New capacities would be ready by the year end. So effectively the contribution would be coming from the next year, because normally die casting, sheet metal, whenever we start making the plants or expanding the capacities, 6 to 7 months it takes to build up the capacities, then the customer trials, verification, the development, cost, sampling, all these comes up. So effectively the revenue additions will be coming from FY 26-27.
Okay. And sir, any color you would give for this quarter? How are traditionally quarter two is for the company and the industry? Q1 is softer, as you mentioned in your opening remarks.
Yeah.
So going forward, how the Q2 is a monsoon affected quarter, but since we are present globally in many countries, so how should we look at Q2 and what we are hearing from the news daily is that the demand for the automobile has shrunk month on month. So will that have any effect or should be having effect on our business profile or our business program? If you could just allude to the same.
I personally feel that the quarter two will be considerably better than quarter one. One reason, one-off contents will not be there. Our businesses that had been set up in the last few years are stabilizing. The new acquisition itself is stabilizing. So I personally feel that we will get a much better and a considerable improvement over quarter one.
Right. Sir, I'll join the queue for follow-up, but there is lack of awareness for investing community since the IPO. Valuations or the enterprise value have remained subdued. So I think with the variety of businesses and lines which we operate, more understanding for the investing community, I think so is the need of the hour, sir. Otherwise, the valuations are not aligned to what the other listed companies in the market are. So we should look into the aspects of what are the reasons why investors are not unable to figure out the value embedded in our company. And I think so, sir, you are coming with this QIP offering. So a lot of work should be done before going for raising capital, because that is a very conscious effect, and that is perpetual capital coming in the company. So diluting the equity and then serving the equity is going to be a perpetual job. So my thought process was there.
No, absolutely. I take your suggestion, and I think we need to play our game or make sure that the effect and the constituents of what we want to do in the future is much more elaborated. It is in an elaborated form for the investor community. If you look at verticalization that I spoke about earlier, that in itself is a way forward in explaining how we want to branch out, and each one of these branches has its own value, which is today embedded and has not been monetized in the way it should be. But we will sit with your community, sir. We will understand your points better. We will try and make presentations in a format where people can understand us today and understand our vision for the future.
Thank you for
Yes,
all the
you want to
elaborate
respond?
answers. Please.
Yes,
Yeah,
Raji,
sure,
you
sir.
want
Yeah. So basically, Mr. Kapoor, as I just told and adding to what our sir has said, like we were operating in a hybrid model with the different product line, different margin profiles. So that's the reason we are going to the segmentization now. And I think we are meeting all the leading investors also, and we welcome you also to join us. And nearly in a year, around 6 to 7 conferences we are attending and hosting also through our channel partners, the research partners. And coming period of time, by this year, we plan to do the entire restructuring so that we have a very clear picture and the plans of each of these companies, how they want to take on the market in coming period of next 5 years. So I think that will be very helpful for the investors to take a wise decision. And soon you will be hearing that, I mean, all these companies into die casting, sheet metal or a parent product, they will be running into good successes, and we are very positive on the same.
Right. And we should look for IR also, sir, going ahead. Appointing an
Absolutely.
investor relation firm. Investor relation firm is also the need of the hour because only
Yes.
for the team to handle these assets in such a big market on a day-to-day basis.
I agree. I agree,
So
Saket.
kindly-
I agree. Absolutely. In fact, you see, if you look at our business, maybe it's gone under the radar. But let's say die casting, where a few years ago, maybe till about 3 or 4 years ago, we were one of the 100 players, and now we are in the top 5. Similarly in sheet metal. So the jump has been dramatic, and we've taken advantage of the opportunities that have been presented to us. But I think we have not been able to present our vision properly to the investor community. And you're right, we will consider having an investment
Investor
outside
relation
external
firm.
agency maybe
Yeah.
for investment relationship, and that will help us in broadening the overall scope and the reach to who we want to reach. Thank you.
Thank you, sir, for all the elaborate answers. Sir, I missed your aluminum die casting business guidance. When we will be doubling the revenue in a year's time, or I think so 3% was contribution for the current year. So what should we look forward with this consolidation from the aluminum casting business growing for the next year?
Yes, Baji, can we give them some reference on the business plan basis of what numbers it is for this year, including the new acquisition?
Actually, we will be ready with this by the end of second quarter. We are waiting with more customer registration. So in the second quarter, in the call, we will be able to throw more light on the same.
Okay.
Okay,
All right.
sir. Okay, sir. Thank you, sir.
Thank you. We take the next question from the line of Preet from InCred Asset Management. Please proceed.
Thank you, sir. Thank you for the opportunity. My first question would be in the line of revenue guidance, which you gave in the quarter 4 of around 14 to 15% ex of Sundram Platon. Is it, and I can see that in quarter 1 there was 7-8% of growth ex of Sundram Platon. So are you still maintaining this target? And if yes, then from which segment you see the growth will be driving?
This is regarding overseas operations, right? Hello?
Hello, am I audible, sir?
Yeah. Can you just repeat the question again because your voice is
Yeah,
down.
I was saying that the revenue guidance which you gave in the quarter 4 was 14 to 15%, and in the quarter 1, the revenue growth ex of Sundram Platon is 7-8%. So do you still maintain this guidance? And if yes, then from which segment will you be getting this growth?
No, let me just bring it up, and then I'll leave it for Yashpalji to quote this forward. I did mention to you that there were 2 customers who had supply issues, and therefore they cut their manufacturing or their production outputs to a little over half. and why they do have plans to cover that up. So in a normalized way, it would have been higher, and we do expect to cover up a large part of what we've lost in the subsequent quarters of this year. Yes, Valji?
Yes, sir. So we maintain our the sales target that we have released in the earlier calls. The quarter one has been exception due to the customer side, but yes, starting quarter two, I think we should be able to achieve the targets that we have set.
Okay.
Hello?
Thank you, sir.
Yeah.
Yeah.
Thank you.
And next question would be in the line of margin. You have guided for 50 basis point margin improvement. So I just wanted to ask, will it be ex Sundaram play-down business, or you are talking about reported basis? Like in FY25, we have done margin of around 10%. So 10.5% would be from ex of Sundaram, or it will be overall business?
So like Sundaram, as I said to the earlier participant, would be not to our expectation that we expect the EBITDA in the current year, but still we have kept a target to improve by 0.5%. So which means anything starting up to 0.5%, we will try to improve it, including Sundaram Clayton. When we say 0.5%, it means the entire consolidated financials. We will try to improve up to 0.5%, starting from 10 bis to 50 bis basis. Any improvement would be there. Yes, the profits, or I would say the margins from Sundram Clayton would not be up to that level in the current financial year, but there are other businesses who are doing good, so they should offset this the gap in the Sundram Clayton margins. But I think up to 0.5%, anything between 10 bis to 50 bis, we should see an improvement in the current financial year.
Okay. Thank you, sir. Sir, my last question will be in the line of your long-term plans. Like, now you have been doing 500 odd crores of QIP, and you are still planning to do inorganic acquisition. I just wanted to understand, what is your aspire segment mix, say, 5 years down the line? What kind of segment mix are you targeting to achieve? Which segments are your main focus areas?
So I'll answer your question differently. Now our focus area would be those segments which could yield us higher margins, profitability and stability in the market, and a good ROC to our esteemed investors. So that is still open. We are evaluating all the segments within the industry, and we will choose the best one to utilize these proceeds as and when we go to the shareholders or the investors to raise this money.
Got it. And if you can give the pecking order for the EBITDA margin in our segments, means what are the top EBITDA margin segments?
So automotive business, locks and mirrors, is the oldest and the highest margin driven business in terms of EBITDA as well as EBT.
Followed by?
Followed by die casting. And I think by the year end, sheet metal will also come into the same line, because most of the projects they have achieved the maturity level, and they have shown a very good turnaround this year with a more than 50% improvement in their EBITDA margins compared to the corresponding quarter of the last year.
Okay, got it. Thank you, sir. And just one question. If you can mention segment-wise capacity utilization of all the segments.
So capacity-wise, if you really ask me, like sheet metal, we are earlier operating around 60 to 65%. Now it has gone up to about 70%, 70 to 70%. And similarly, in others also, we are operating like around 60 to 70%. And as far as, because we operate in different segments, the product natures are different, the lines in case of the assembly business are different. So specifically, if you ask me how many machines are running at what capacity, so it's I would say composite average figure. But yes, we have capacities to achieve the sales target that we have set, the revenue target that we have set for another 3 years of time. That much of capacities we have built up. And further, we will be going for some inorganic route also, as Chairman Sir has said. So that we will be evaluating.
Thank you, sir. I'll join back in the queue.
Thank you. Thank you.
Thank you. The next question is from the line of Ashish Soni from Family Office. Please proceed.
So regarding this acquisition which you are planning with QIP money, so any particular business line you are looking to diversify, and what's your typical parameters in terms of acquisition, in terms of ROC or margin accretive? What's your typical guidelines? So can you throw some light on that?
So like this fundraising 500 crores, first is the first step towards going for any inorganic or a big investment. So we have sought the board consent. Now we'll go to shareholders approval. And once we get this approval, at the parallel, we'll be working on couple of opportunities in the organic space. But thing is that if those comes with a good valuations and as well as the good future prospects in terms of return on the investment of the acquisition price that we are paying, then we'll be considering. This QIP approval will be valid for a period of 1 year from the date of shareholders approval in the upcoming ensuing AGM, which is planned on 19th of September. So between this period of time, we'll try to, but we will not be in any rush or hurry to acquire any of the businesses just to invest the money. We'll be prudently evaluating it. And if it suits the valuation price as well as the future prospects in terms of returns and earnings, then only we'll opt to go. Otherwise, we'll see how to move it because it's not compulsion on our part to just raise the money. We'll evaluate it very prudently. That's what I need to say.
But what's your typical criteria, like when you acquire a company now, like in terms of ROC or return on investment, what are your typical parameters? I'm trying to understand that. And if you are saying acquisition will be in the similar business line you are already there, it's something new. I'm trying to understand that piece.
So we are operating through auto industry. Auto industry is very wide. So within auto industries, even we can switch on the products also, as I said, if the opening is good. In terms of ROC, yes, we are looking at a ROC which is above 18% post-tax. That's our target to acquire the businesses. It might not be possible that within the same year we acquire any business and generate 18% ROC. When I say 18%, from a perspective of 2 to 3 years from the acquisition. And I think this is the best return which an auto component company can give to its shareholders or the investors. Above 18% post-tax, I don't think it's possible for any company to give from the core manufacturing activity.
Last question, in terms of Trump tariff, how much of your or your customers or business are getting affected across the world?
So if you see a revenue mix, more than 89% is coming from Indian operations, which are not supplying directly to any US. So it is unaffected. As far as the overseas business is concerned, Mexico plant is supplying to US, but tariffs are not on us, but it's on the customer. They are bearing it. So directly we are not affected, but yes, the volumes have been down in entire Europe and US markets. That loss of business, or I would say slowdown in the business is affecting. Rest, directly we are not affected because of this.
Okay. Thanks and all this.
Thank you.
Thank you. We take the next question from the line of Radha from BNK Securities. Please proceed.
Hello, sir. Thank you for the opportunity. Sir, a lot of changes has happened in the key managerial position in the company over the last 2 quarters. So what are the internal targets that the company is looking to achieve with these changes?
Dada, you mean to say the managerial reshuffling of portfolios?
Yes, sir. Like you have given a lot of new appointments have been done in the senior management position. So with regards to that.
Okay. So rather thing is that as we have mentioned that now we are expanding and we are bifurcating the businesses into the subsidiary company which are very product specific like die casting, sheet metal, and the parent company into the automotive, I would say the technology driven products. So now the time has come up that we appoint the persons who are directly responsible to take over those businesses in the markets. So that is this exercise of nominating SMPs as well as increasing the number of KMPs and reshuffling their portfolio is a part of that entire exercise. We want to appoint the persons, make them responsible, delegate them the powers and authority to go and tap the market, explore the markets and grow their businesses. And if one has to expand, then these sort of leverages has to be given to the staff. So that's the reason we are creating a structure whereby the separate companies are identifiable. They have a separate set of management. The people are free to take decision up to a certain level as approved by the individual companies boards in terms of financial autonomy, in terms of operational autonomy. And this entire reshuffling is the beginning of the same, I would say.
And rather, you would have noticed that it's not as if it's internal reshuffling. Which basically means we are concentrating on the right attributes of the right people to run the right businesses. That's what's been done. Most of it is internal. there is not too much of external incoming into the company. And we do believe that we have a strong team, and the strong team now placed where they are in this new structure would be able to deliver the vision that the company has for the next few years.
Yes, sir. Thanks, sir. Sir, secondly, Mr. Neil Dawar is on the call this time. So just wanted to understand a little bit from him with regards to his thoughts and visions regarding the company. Where does he want to see the company in the next 3 to 5 years?
Neil, you want to come in?
Can I answer? I think. Hello?
Neil,
Yes, sir.
is he in the call? I don't know. Maybe he has a bad connection. He was in the car.
I think the call is dropped now, sir. So there is some network issue.
Okay.
Should I answer, sir? You are answering.
Yeah. Go ahead and answer, please.
So rather, the question is that, like you see, we are working on successions also within the managerial team. And Mr. Neil Dawar is a part of the promoter family also. And the purpose, he is aligned with the same vision that we are having as an organization. And he would be driving along with Mr. Jayan Dawar to achieve the vision of the organization. So his vision remains to be the same vision on which we are working as a management team.
Rather, to answer your question in simple forms and supplementing what Mr. Yashpal Jain has said, the vision is not my vision or his vision or somebody's vision. It is the entire company's vision. And everybody is working in tandem to make sure that the future, as we explained to you in whatever form we could today, is those targets, both executively and in terms of delivery, are met with.
Thank you, sir. So last question is, till date, how much have you invested in the EV products? So you mentioned that the customer feedback from the EV products has been good. So with regards to that, how much are you expecting in terms of revenue for the next 2 to 3 years from these products?
So you are referring to the investments rather first. The first part was the investment that we have done in EV.
Yes, sir, investments and next 2 to 3 years revenue targets.
So investment as of date, including all the operational development costs, it is close to 21 crores that we have invested into the EV business. And largely, if you see, the entire money has gone in developing the products, paying some fees to the technological partners, and marketing expenses. So in the coming period of time, depending on the EV offtake within the country, they have orders, they have customers, but largely it all depends on the volume. But we are positive. But yes, 2 to 3 years, you can't assume that it can just cross 100 crores within a year. Would be a growth this year. This quarter, we have been just close to 2 crores of the revenue. Going with that, you can expect that the coming years would be good for EV. But as of now, it's very difficult to give any ballpark figure also for the EV. But product-wise, we are ready now. All variants of the product are ready, and now we are ready to penetrate them in the market. And we are reaching out to all customers, existing companies as well as the new age companies.
Understood. Thanks and all the best to the team.
Thank you.
Thank you. We take the last question from the line of Preet from Incred Asset Management. Please proceed.
Thank you for taking my question back. I would like to ask about the JVs. Like I've seen that in last 3 years you have exited 2 or 3 JVs. So are you planning to stay with all 5 JVs? And what was the revenue and EBITDA margin for Q1? And what do you expect in full year? Thank you.
Sure. So I'll answer first, the second part of your question first. So this quarter, if you ask me the revenue of all these 5 JVs together, our share of revenue was 37 crores, the JVs. And they achieved a EBITDA margin of 10.72%. and the PAT of 5.15%. So I think it's very decent one compared to double-digit margin in EBITDA and 5.15% in PAT. So as of now, all these JVs are performing very well. And as in the opening remarks, our chairman has said that we are evaluating the JVs, how they are performing, whether they are aligned with our motto and vision in the future. And at the right time, we will take the right decision. But as of now, yes, we are continuing with the 5 JVs. That's the truth. Hello?
Yeah. Thank you so much, sir. That was helpful.
Thanks.
Thank you. As there are no further questions from the participants, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Once again, let me thank Chirag from MK and Anushka for organizing this call. I want to thank all the people and all the participants who were present today and gave us a patient hearing. I want to assure them that there were a lot of suggestions that have come from you, and we would make sure that we listen to each one of them and see whichever ones are appropriate and make sense in the overall growth and vision of the company. We incorporate them accordingly. Thank you all once again, and look forward to having a chat with you again in the next quarter. Okay, with that, thank you all once again.
Thank you.
Thank you.
Thank you. On behalf of MK Global Financial Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.